There's a handful of advantages and a handful of disadvantages to buying a home instead of renting. But when asking yourself, is buying a home the right move for me? The number one factor here is affordability. What price can I expect to pay? What will my interest rate be on my mortgage? What are some of those overlook costs, like maintenance and repairs? These are all things you want to consider to avoid falling into a money pit situation, because buying a house is not something you can quickly undo. Let's look at the affordability and the expected cost of buying a home at an average price, financed by an average mortgage, facing both common and uncommon maintenance and repairs. And before we run the numbers, keep in mind this is national level data. So your individual situation where you live could be drastically different. But the takeaways from this are the same. According to Redfin's database, the median selling price for a home in June was about $443,000, and the national average 30-year fixed mortgage rate sits at 6.9%. So if you were to buy a house at this price point, financed at this mortgage rate, and assuming the classical 20% down payment, what is the expected cost of this transaction? Well, first things first, your down payment. 20% of $443K comes out to $88,600, which means that you'll be financing with your mortgage a total of $354,400. Now, in addition to your down payment, there are other upfront costs to buying a home, which fall under the umbrella of closing costs. Some items are the loan origination fee, appraisals and inspections, required insurance, and taxes. Generally speaking, your closing costs will be somewhere between 2 and 6% of the mortgage amount. In our example, that equates to closing costs from about $7,000 at the low end to about $21,000 at the high end. Let's just split the difference and call it $14K. So if you add that to the down payment, you get your total expected upfront costs, which is $102,600. That's a lot of money right off the bat. Now, what about your payments every month? Inputting our home price, down payment, and terms of the mortgage, we get a monthly bill of $2,334. A portion of that is paying down your principal, and a portion is interest. Note, this does not include other recurring bills like utilities, home insurance, and HOA fees. So you would need to account for those as well. Another cost that often gets overlooked because it's cooked into your monthly payments is the total interest paid at the end of your 30 years. Assuming no early repayments or refinancing, the total interest paid on a $354,400 mortgage is nearly $486,000. That's right. The amount of interest you end up paying is more than the total amount you borrowed. On top of all that, at the end of the year, you need to be prepared to pay property taxes. And who the hell wants to pay more of those? Depending on what state you live in, you could be faced with a significant tax bill on the scale of thousands of dollars. For instance, if you're in California with an effective tax rate of 0.7% and an average home value of $978,000, your taxes would be almost $7,000. If you're in Vermont with an effective tax rate of 1.29% and a home value of $483,000, your taxes would be close to $6,000. The average effective tax rate across the 50 states is 0.88%. So taking our median house price of $443K, we get a yearly property tax of $3,900. And because a personal residence generally doesn't generate revenue for you, that's a tax bill you'll have to pay out of your earned income or your savings. Let's touch on maintenance and repairs from an overall sense, because these are the expenses that will have the widest range of both frequency and cost. As a homeowner, you'll obviously have the recurring stuff like lawn care and general upkeep. But it's the catastrophic repairs that can blindside you. Just to list three and to look at their expected cost: HVAC replacement, foundation repairs, and roof replacement. Installing a new HVAC system will cost you an average of $10,000. Repairing your foundation falls around $5,400. And replacing your house's roof can cost an average of $11,500. That's a lot of money, a lot of stress, and a lot of disruption to your daily life. Worst case scenario, these things happen early in your home ownership after all of those upfront costs. Best case is they never happen. But no matter what, you'll need to be prepared to foot a bill that big, plus the smaller stuff. In fact, some suggest setting aside 1 to 3% of your home's value each year to cover your maintenance and repairs. For our $443K house, that's about $9,000, assuming we set aside 2%. And now you have the full picture of what it costs to own a typical home. Let's recap. For a home valued at $443K, your upfront cost will be $102,600. Your monthly payments will be a mortgage at $2,334, plus utilities, plus insurance, plus HOA fees. Your property taxes will be $3,900, and expected maintenance and repairs will be $9,000. Underneath it all, after 30 years, the total interest paid will equal nearly $486,000. Owning a house in today's environment is not cheap, y'all. Probably the largest expense you'll take on during your lifetime. But many people still value homeownership as a financial milestone and as a way to gauge their life success. So if you're set on buying your home, I think that's great. Just to make sure you fully understand what you're getting into. Please do not get blindsided. It can really set you back financially. But anyways, we'll leave it there. Hopefully you took something away from this and it helps you make a decision in the future. If you want more videos like this, give this one a like and consider subscribing if you aren't already. If you have any questions, leave them in the comments or feel free to email me at askalexherrera@gmail.com. As always, thanks for watching. Until next time, take care of yourself and best of luck.